which is the best technical indicator I can use when trading Forex? Now, this is a question I get asked at least once a month. And just so you know, there are a deluge of different technical indicators to choose from, which can help you towards your Forex trading success. You get traders that recommend indicators like stochastics and ADX and MACD and moving averages.
5 minutes later.
Bollinger Bands, all those things. Don't worry about any of those jargon terms because you don't need them to make money in the Forex market. Many traders try to incorporate over 3 or 4 of the indicators, and they try to develop that perfect strategy. And I have a huge problem with this. So let me explain. Amateur Forex traders are trying to find that surefire indicator that will always win. Now, most Forex traders start off by learning how to use these indicators, but what they don't do is take the necessary time and learn the meaning of each one. They all try to find that indicator which will bring them 100% win rate of all winning trades. But let me tell you this, in a $5.3 trillion a day industry in the Forex market, there is no such thing. No one can ever predict the market with exact certainty, especially the Forex market. And every killer indicator at the end of the day is based on past data. It's historical. And this is probably the most important factor you must consider when you choose to develop your Forex trading strategy, right?
Even with in 2020, with the new type of indicators and artificial intelligence and quantum computing, even if you got all that data and you assembled it and compiled it all in one to determine what the future price could be, the thing is, just by taking that data and compiling it, you're already using past data to try and predict the unknown. So it still stands.
No matter what indicator you choose, they are all based on the past. And I honestly can't think of one indicator in this entire world that has any form of predictive qualities.
When you add an indicator on a chart, it only can show you one of 3 things. First, it can show you the current momentum on where the market is going. Then to follow up, it will show you the current trend direction, and also you can see the past historical trend directions. And the third thing is that it will show you demand and supply on the buying and selling volume within the market at any one present moment.
I mean, how on earth can you predict where the euro dollar is going to go when millions of traders are buying and selling the currencies at any one time? Not only that, but there are countless economic factors, socio-political factors. There are other factors that you have to consider with any one currency pair. So let's say that we had this miraculous computer that takes in every factor that causes the currency pair to move. And every factor is put into a strip of data on your computer and it assimilates the data. Guess what? It's still based on historical data. So, if you can't predict the Forex market with any indicator, what can you do to make money? I'm not going to sell you anything, so don't worry. When I make any Forex trading decision, I solely depend on one thing, the trend. If I see the euro dollar's going up, and it has been going up, then I'd rather follow the direction of the trend than predict that it's going to turn around. The probability that the euro dollar will continue to go up is higher than the probability of it turning down. So why go against the trend?
All right, so I'm going to argue and say that a trend is not the only thing that you need in order to trade a certain market. You need certain elements within a trading strategy in order to take the trend. So the first thing is that it doesn't take just a trend or one indicator. It doesn't take just a few rules, and it doesn't just take money to become a trader. You actually need to combine all of those elements together. And I like to call it the 4 M's, which are the markets. You need to know which markets you want to trade. The method, which is the strategy that you're going to be using to get into your trade. The money, which is the amount of money that you're willing to risk psychologically and that you can handle with each trade. The fourth thing is mind. And mind is a psychology of being able to handle your winners and losers effortlessly.
And when I trade the Forex market, I look at 5 simple patterns and I follow strict money management principles, and that's it. So let's get this straight. Forex trading is a get-rich-slowly scheme, but if you follow your rules and you do it right, it's a get-rich-surely scheme.
So even though it is a sure way to make a second income, you still need to spend the time and you need to make the effort to sit down every day, look at your charts, look at your indicators, and see what is lining up for the day and for the week, and then follow your strategy as you need to in order to, make it as a trader. The video still stands. There was one thing that I needed to argue, which I think I dealt with today. And compared to 2014 to 2020, the markets are pretty much still the same, that they move up, they move down, they move sideways, there's volatility, there's liquidity, there's black swans. So there's nothing really new to trading that I've kind of gathered over the years, except for now. I mean, we've seen markets crash over 40%. We saw oil crash over 40%. We saw the Dow Jones crash 30%, and the JSE and the S&P 500 and the DAX. And I mean, these are bigger moves than what we've seen compared to the financial crisis in 2008, 1997, and even 1987. So we are in unprecedented times. And now the thing is to follow your strategy, maybe risk less than ever before, because in unpredictable markets, the volatility can be shaken into ways where the market can move up 10% in a day, then down 12% in a day. So as a trading strategy, we might need to increase the stop loss and entry level compared to when the volatility is a little bit lower, because we don't want to just get stopped out of the market just for it to rally up and hit our take profit.